Hi, I'm Chris Sabula, and I'm here with Mark Armbruster. We've been thinking lately about inflation. It hasn't been a big factor in the economy in many years, but the topic seems relevant lately with all the government stimulus programs that have recently been announced.
Inflation is simply an increase in the overall price level of goods and services within the economy. A little inflation is positive and normal. After all, we don't want prices to fall, despite the fact that deflation or falling prices could make shopping more attractive for some of us. A decline in home values and other assets would be bad for individuals, and if we had a regular decline in prices of goods and services throughout the economy, that would be bad for businesses.
This is also true for investment returns. If you earn a 5% return in a period of no inflation, you get to spend the entire 5%. Whereas, inflation of 3% would erode your real return or amount that you actually can spend to a mere 2%. Measurement of inflation is generally done through the Consumer Price Index, or CPI. The U.S. Bureau of Labor Statistics releases monthly CPI data that tracks the level of prices that consumers pay for a pre-specified basket of goods and services. While there are a number of adjustments and statistical abnormalities that have resulted in debates about whether CPI is accurate, most will agree that CPI presents at least a directional perspective on overall inflation. While inflation has not been at an elevated level in many years, the topic is again coming up among economists and strategists.
In response to the COVID pandemic, the federal government has launched a number of economic stimulus programs. This includes a $2.2 trillion multifaceted program to help individuals and small businesses with the economic challenges of the recent shutdown of the economy. Separately, the Federal Reserve has also pumped just an astonishing amount of money into the system by purchasing financial assets. This amounts to another $3 trillion. Additional programs are being discussed, and foreign nations are largely taking similar actions.
The reason for all this action is in the hope of stimulating the economy to prevent it from tumbling into a deep recession and or a deflationary spiral. These actions are and can be controversial, but it is not the first time large economic stimulus has been implemented.
That's right. This graph shows that while the Fed has injected unprecedented levels of liquidity into the economy, they've acted with similar tools in the past. During the 2008 financial crisis, for example, the Fed's holdings of financial assets also rose precipitously. In fact, as far back as the Great Depression, the government intervened to help prop up the economy during times of economic stress. New Deal programs during that era provided wages when the private sector jobs were not available, and special bonuses were paid to select groups like farmers and veterans as a way of getting more money into the hands of consumers.
While it's important to keep the economy from grinding to a halt, pumping large amounts of money into the system could create a different problem: high inflation. After all, we learned in high school that inflation really comes down to too much money chasing too few goods.
Before the pandemic began, we had a very robust economy in the United States. Unemployment was at multi-decade lows, interest rates were accommodative, inflation was tame, and GDP was growing at a steady clip. So when the economy reopens, it's not unreasonable to assume that growth will resume, even if it's not quite as strong as before.
Also, there could be pent-up demand for goods and services since folks have been quarantined and largely unable to spend for the past several weeks. Incremental demand and lots of money in the system have the potential to push prices higher in the overall economy. Thus, many are warning of rapid inflation in the years to come.
While that theory makes a lot of sense, theories don't always play out in practice. The same warnings were discussed in the 2008 financial crisis, but we've not seen significant inflation in the past decade. That was also true for the Great Depression. Concerns over government stimulus-induced inflation were largely unfounded until a couple of years after the end of the Depression, and even that might have had more to do with the onset of World War II.
To be sure, there are also deflationary forces at work. Commodity prices, such as oil, seem unlikely to rise rapidly from their multi-year lows. Airfare and other travel-related costs probably won't rebound in the face of weak demand. Also, technology tends to get cheaper over time, and globalization has kept prices low over the past 20 years because labor is often less costly in other parts of the world. These forces are unlikely to change anytime soon.
So inflation is a very real possibility, but far from a certainty. What's an investor to do?
There are investments that have been noted as being inflation hedges, such as gold, real estate, and tips, or treasury bonds that are indexed for inflation. However, none of these is perfect, and we would argue it doesn't make sense to tilt your portfolio toward any of these investments. Gold has historically earned the returns of cash, but experienced the volatility of stocks. So low returns with high risk, the opposite of what you want. That is true of many other commodities as well.
Real estate's a fine investment and maybe should be part of your portfolio, but not too large a part. If the economy doesn't recover as rapidly as many anticipate, or if demand for space falls off as businesses shift more permanently to work from home and consumers further embrace online shopping, there's a risk to real estate valuations.
Tips can be a hedge to inflation if implemented properly. In fact, they could be a better bet than other types of bonds. Generally, bonds fare poorly during periods of high inflation, but with an ultra low interest rate environment, no high quality bonds will earn very much in the years to come, including tips.
Probably the best approach is to have a healthy allocation to stocks in your portfolio. While stocks are not a direct inflation hedge, the growth they provide over time has historically been able to keep pace with inflation. The left-hand part of this graph shows that both stocks and bonds generated positive returns in the mid-1970s through the early 1980s. However, these are nominal or before inflation returns. The right-hand graph shows that after adjusting for the impact of inflation, stocks were about flat and bonds actually lost money during the period.
It is usually not practical from a risk perspective to put all of one's money into stocks, but having a portion of your portfolio in stocks could help protect against purchasing power erosion if we experience high inflation in coming years.
So while inflation is a possibility, it is far from certain. Accordingly, investors should not make radical changes to their long-term investment strategies. Just having a well-balanced, diversified portfolio is generally the best approach. After all, inflation is one of many risks that investors face, and by trying too hard to hedge that, you may unwittingly expose yourself to other risks.